Hey everyone, welcome back to Fiscal Voyage. My name is Felix, and today's video we're going to talk about this new dividend growth stock that I just purchased. I actually own shares, and I was down about 10 or 11%. And I bought shares to kind of lower my cost average on this stock. And the stock is UPS. You can see here I bought shares of UPS, 14 shares of UPS, around 136 and 54 cents, almost $2,000 worth of shares on UPS. And I'm going to go through the technical analysis and the fundamentals analysis of the company to show you why I bought more shares of UPS. And also, that same day, I got filled, or on Friday, I got filled with Nike shares, 100 shares of Nike, because I sold some puts prior to their collapse in earnings at $82.50. So I own 1,000 shares at an average cost at $82.50, minus the original option of puts I sold. And I also sold some calls at $82.50 for $2.30, so around 230. So this lowers my cost average to around $80 or $79 if you considered also the put that I sold to be assigned. So I own shares roughly at 79 cost basis for Nike, which is okay to hold. I am also, once this is, I'm gonna continue to sell calls on Nike to earn more premiums and collect more credit income for this uh, order here. But anyway, let's go to UPS. So you can see here I bought 14 shares. And I'll show you why I bought 14 shares. So first we look at the fast graph on the UPS. First off, the company is a A credit rating, which is investment grade, which is good. It has an earnings yield of 6%. But again, remember, this is uh, based on today's this price at 142, and I bought shares at 136. So the earnings yield was higher than six. I think it was like over 6.5 earning yields. But you can see here on fast graph, the company does have some down years on earnings. So over here, 2008 and 2009, which is understandable. But also here recently in 2023 and 2024, they had down earnings. So this is what kind of brought the price down. You can see here it was as high as $217, $220 for UPS, and now it's all the way down to at 130 or 140 now. You can see here how it's got been down. If we go from the top to its current price, is down roughly 36%. And this is because earnings dropped 32%, 7%, 23 and 24. But good thing is they are expected earnings to bounce back very nicely. 2025 earnings expected to be 19% increase, as well as 2026 16% increase. So this is why I bought shares of this company. The dividend payout ratio is pretty high, actually, around 80%. I would like to see this lower, and it looks analysts are expecting it to be lower dividend growth. So this should allow earnings time to continue to increase to decrease the dividend payout ratio. You can see here in 2026 they expect the dividend payout ratio around 60%, which is kind of where I like that, under 60%. Some other things, if we go to forecasting long-term growth, you can see here analysts are expecting about 8.7% annual growth rate for the next 4 or 5 years. So that's good. So that's going to drive the price higher. We can expect a 12% annual rate of return. Again, this is based on the 142 price. And I bought shares at 130. What was it? 136 there. Another thing I like here in analyst scorecard, they're pretty accurate with the analysis, expected earnings, so that's good. This is what I like to see. So now we go to other analyst score here. You can see here Morningstar gives it a 4-star rating, which is a buy with a fair price at 158, and this is at 136. So this is why they have it still a 4-star. Possibly now, if they update this price, it'll probably drop down to a 3-star. But anyway, it gives a 4-star rating. Some other key things that I like about this here, you can see down here, we scroll right over here, you can see here they're expecting earnings to continue to increase, dividends to continue to increase. So these are all things that I like. Price to sales is under 2, around 1.1, 1.2, so that's real good. Price to earnings, P ratio, forward P ratio drops lower and lower. That's because earnings are continue to increase, and the revenue growth has been, on the low end around 2.4 for 2024, but then expected to pick up in 2025 close to 5%, and 2026 4.4%. So those things I like there from Morningstar. And now we go to CFRA. CFRA gives it a 3-star rating, which is a hold, with a 12-month price target of 149. What I do like to see here is this 3-year projected earnings growth, compound annual growth rate at 11%, which is good. They give it a quality rating of a B, which is good also. And you can see here, for the quarters, for the year, earnings expected to be $8.22 for 2024, and then 2025, $9.96. So earnings expected to grow next year. So that's going to drive the price of the stock higher. CFRA does have a fair value price at 132, which is kind of lower than what the current price is. But that's okay. This is where we get averages and to get a good estimate on what fair price is, because based on FastGraph, I put this around 11 years. The fair prices should be around 143 to between 143 and 170. That's kind of where the fair price based on the expected earnings. So this is why I bought shares of this company. Now, if we look at the chart, the analytical chart, you can see here, if we go to the monthly, you can see here there was strong support here around the $130 area, 130, 135. So this is why I bought shares. I was like, oh, there was a good bounce there, and we got this strong support here. If we draw this right there, oh, let me fix that. Right there, you can see how this is strong support. This area is a great buying area because you have previous resistance right here. Now it become support. So now this gives us like a big buy setup. It broke out, and then it came back down to this area of support to then drive the price higher. So this is what I kind of am looking at. I would buy more shares if it comes down over here around the $120 to $100 area. I will buy more shares if it comes down to this this monthly 200 moving average. You can see here during COVID, it bounced very nicely. So I would expect kind of the same thing here around the $110 to $100 range. I'll buy more shares here. And I expect to bounce there very nicely. And you can see here, so that's what I liked. And this is on the daily chart. After the CPI numbers that came out on Thursday morning, this is when I bought. I bought right as the market opened after the numbers. I was like, oh, let me buy this company, because I wanted to buy the two stocks I talked about in my previous video, OZK and what was the other one? Oh, PPG. But they bounced kind of before CPI, and I was like, crap, I missed my opportunity to buy. So that's why I bought UPS, because again, you can see here, strong support here. It was bouncing here, and then the good CPI number. I was like, okay, let me just buy UPS. And so far so good. I had a good 2-day run up. So I like that a lot. So that's why I bought UPS, and that's why I'm holding. Right now, I'm not gonna buy no more shares. The next opportunities that I plan to buy more shares, kind of let it do its thing, and then if it comes back down here to around 120 to $100 area, then I'll start consider to buying more shares of UPS. So thank you for watching, guys. If you like this video, make sure you hit that like button. If you're new to the channel, make sure you hit that subscribe button for more videos like this. Thank you, and I'll see you in the next one.